Okay, so that gives some background to why we at the Riksbank are particularly interested in exchange rates and monetary policy and the relationship between them. So we'll jump right into the program. I will be chairing this first session. We have a first paper by Jesper Lindé, who is currently at the IMF, previously has spent a lot of time at the Riksbank. A few rules for the sessions before I give the word to Jesper. We have in total 1 hour for each paper, including discussions. So the time allocation will be that the presenter is given 35 minutes for the presentation. The discussion then gets 15 minutes, and we then have 10 minutes left for the general discussion. And I will remind speakers about the time when 5 minutes remain. During the presentations, we will allow only for clarifying as usual. And for the general discussion, I will first give the floor to our panelists and then collect questions from other participants via the Q&A, where you are free to ask questions, of course, also during the presentation, and we will collect those questions. So please, Jesper, the floor is yours.
Okay, thank you, Ulf. So I'll try to share my screen here with the paper. Share and view full screen mode. All right, that looks good. I hope that you see my presentation. So thank you, big thank you to the organizers for the opportunity to present this paper at this prominent conference. This paper is joint work with my current IMF colleagues Tobias Adrian, Christopher Erseg, Pavel Sabsuk, and Jianping Zhu. And it is one component of the IMF's work on something the IMF calls the integrated policy framework, which sort of opens up the door a bit that you know, additional tools for some countries, additional tool to interest rates might be needed for good macroeconomic stabilization. So let me jump into the motivation, which is that over the last 2 decades, we have observed that many emerging market economies have moved away from fixed exchange rate regimes and adopted inflation targeting frameworks. However, in contrast to advanced economies, many EMES with IT frameworks have continued to rely on foreign exchange rate interventions and FXIs, and some also use capital flow management tools to stabilize exchange rate. So why? One can ask. You know, and I guess their answer is that volatile capital flows are a predominant source of concern, and that's been documented in various papers. And that means that they often face policy dilemmas when hit by large capital flow shocks. And you know, their argument then is that one instrument is not enough. So for instance, if they have a period of very high inflows and they want to lower policy rates to deter those inflows, that may lead to a domestic credit boom. So it might fuel a domestic credit cycle. On the other hand, if you have an outflow episode and you pursue contraction in monetary policy to lean towards that outflow, that might risk weakening economic activity in a period where, you know, that is not desired. So these large swings in capital flows can be problematic for them to handle with one instrument. Now, what we do in the paper is develop an empirically oriented new Keynesian model to help quantify how multiple tools, so including FXI and CFMs, can potentially improve the policy trade-offs these countries face. And the model we set up is you know, intended to capture 2 key EME characteristics. So first, it builds on substantial empirical evidence showing that exchange rate changes tend to have larger and more persistent effects on inflation in EMEs than in AEs. And I think here is a body of evidence on this. And, you know, for instance, the IMF WEO had a chapter on this in 2018. Second, the model includes a balance sheet channel, capturing that exchange rate changes may have large effects on domestic financial conditions. And Shin and Bruno has worked on this to establish this. Now, so, I just want to say that, our quantitative approach here, that complements, it's a very nice paper, I think, by conceptual model on this by our IMF colleagues led by Jita Gopinath, who sort of sets up a model, a simpler 3-period model, who can show analytically for an optimal combination of IPF tools. In one dimension, we're less ambitious. We're not going to show you any full like Ramsey policies here. But what I think is the pro with our work is that we have inflation here, which is a key variable for a central bank. So there's a model where inflation is a more traditional dynamic infinite horizon model that can be used to estimate. You can use our model to estimate it off the data. All right, so the presentation outline is going to give an overview of the model, going to talk about the trade-offs associated with exchange rate shocks. When I only think about like this in monetary policy credibility, that may be an issue for some EMEs. Then I'm going to turn to more large shocks, sort of COVID-style scenarios, and explore there how additional policy tools might be useful to provide macroeconomic stabilization when hit by large shocks. And that is going to be in terms of sort of impulses. But then I'm going to turn to stochastic simulations of this model and show that there may be significant benefits of systematic FXI CFM policy rules which complement interest rate rule that the central bank, so giving in a sense the central bank additional instruments to do macroeconomic stabilization when faced with sort of shocks hitting the economy. And finally, I'm going to make an application to liquidity traps in order that FXIs, for instance, can be helpful, can be a sort of a complement to other unconventional monetary policy tools in a central bank's arsenal to deal with long-lived liquidity trap if inflation risks to become anchored. And then I'm going to conclude, and I count on you all to keep track of the time for me. So let me know when I have 15 minutes. All right, so key features of the model, so it's a standard small open economy New Keynesian model used to, that we can use to quantify how using multiple policy tools can potentially improve policy trade-offs and outcomes. And it accounts for a balance sheet channel and includes other frictions to match the data, which are useful to match the data for a wide set of countries. But there are some nonlinearities in the model. I'm going to explain those nonlinearities. And those nonlinearities means that the effects of shocks will depend on initial conditions and how well inflation expectations are anchored. So in our framework, in fact, shocks can have strong nonlinear effects under certain conditions. For instance, a risk-off shock can have very, very different effects on an economy which has weak initial conditions, say have a large foreign debt relative to a country which is not as vulnerable. And what I'm going to discuss is based on sort of what we think is a reasonable calibration, but we have ongoing as part of our agenda is to develop sort of this model to be like a technical assistance tool that can be used for many countries. So we're currently doing estimation on a number of emerging markets economy with Bayesian methods. So some more details on the model. So it's a small open New Keynesian model, which is tweaked to capture these differing degrees to which inflation expectations are anchored. So key features of this model is, incomplete financial markets internationally. We have imperfect exchange rate pass-through, which has dominant currency pricing as a special case. But, we estimate this, this is part of estimation. So you can in principle have PCP, LCP, DCP in the model. We don't want that future monetary policy can be too potent, so we are introducing discounting in the IS and Phillips curves to address the forward guidance puzzle in the model. And then we have the state-dependent balance sheet channel, where we're going to have this sort of private borrowing spreads. It's going to depend on external liabilities and the real exchange rate in a way I'll describe later. And then we have sticky wages in the model too, because we want to think about, which we think is an issue for EMES, where compensation, if you have a large exchange rate depreciation and the labor unions ask compensation for this depreciated exchange rate and raising wages, which then of course raise marginal cost and put upward pressure on sort of core and domestic inflation. So that's why we think it's nice to have this feature in the model. As I said, this is sort of, most of the model is sort of linearized, but then we have a couple of nonlinearities in the model to sort of allow for the state-dependent effects. And there we have a nonlinear. We don't linearize the UIP risk premium, so it's going to be a nonlinear UIP risk premium embedded into the model, and we're going to have also nonlinearities in the private borrowing spread. And we also have, when I do the liquidity trap, we have effective lower bound on the policy rate, but that's later. All right, to give you some more idea about the model. So it's going to be aggregate demand is going to be determined by consumption, which is endogenous, evidently. Real net exports, also endogenous, but then we have also government expenditure, but it's exogenous. So the model abstracts from endogenous capital accumulation. So in a sense, CT here will capture endogenous fluctuations in domestic absorption. Monetary policy is not going to be optimum monetary policy. It's through the lens of a standard Taylor rule, which is a bit, in terms of inflation, it's a bit forward and backward looking. It looks 1 year ahead on the year-over-year inflation and the current year-over-year inflation rate. And then you have coefficient on the output gap, and then subject to the effective lower bound. So you have minus I there because it's deviation from steady state here. Now, more important in the model is this modeling of inflation, and there is a domestic Phillips curve here, which allows for some intrinsic indexation through this iota D parameter. And then, you see this discounting parameter here, which provides some additional discounting of future inflation expectation marginal cost. And then you have a coefficient times marginal cost. Then you have the wage Phillips curve, which is sort of standard. It's a labor market wedge there. But what is non-standard here is this how the modeling that a weakened exchange rate might lead to wage compensation demands, and that we capture through this pi L. So sort of we call it long-term inflation, and that enters through this indexation coefficient iota W. And here you have that if you get a large depreciation, so the consumption-based real exchange rate depreciates, that long-term inflation spikes up, and it has some persistent, and it will, cause for compensation in terms of wages, which then will affect marginal cost. And here is gonna differ between AEs and EMEs. So in terms of parameterization of the model, we adapt standard values for most parameters in the model, which are the same then for AE and EMEs. And we have in the baseline model, we have a degree of openness, so the import-export ratio is 0.2, 20%. But the key difference to begin with is going to be between AEs and EMEs pertain to the pricing equation. So for AEs, we want to have a fairly low slope of the Phillips curve of 0.005. And, the Chair Powell acknowledged when, the Fed announced the recent AIT, a flat Phillips curve. And I think there's a lot of literature now, recent evidence pointing towards a very low slope of the domestic Phillips curve in many countries. And we capture that in AEs by this low coefficient. We have a somewhat higher slope of the wage curve, which we think gives rise to reasonable wage dynamics. And then we allow for some intrinsic persistence in the Phillips curve, not too much. 0.5 actually is not too much. Maybe it's I think roughly comparable to what you see in the data. But then importantly, no of this long-term inflation. There is no indexation of wages to movements in the real exchange rate. For EMES, we have a slightly higher slope of the Phillips curve, pricing Phillips curve, slightly higher slope of the wage Phillips curve, but most importantly, there is more, we capture this degree of indexation or monetary policy credibility, how well inflation expectations are anchored by a higher coefficients for this intrinsic persistence in the pricing and in the wage Phillips curve responding to exchange rate depreciations. We also have, of course, it's an open economy block, so I also have pricing equations for export and imported goods, and there we allow for somewhat quicker pass-through exchange rate to imported goods, to import and exported goods in EMES than in AES, but that feature is actually not crucial for this panel I'm going to describe now. And okay, so what's the idea behind this? The idea behind this different calibration is to try to capture, the VR and local projection evidence on the effects of exchange rates on inflation. So here is some, empirical estimates on the effects of a 10% exchange rate depreciation on inflation within 1 year. And if so it's a panel approach, so they take a panel of countries and they run these regressions, and roughly for AES you have 0.6%, so an elasticity smaller than 1. For EMES in Asia, you have a slightly bigger than unit elasticity between 1 and 1.2, and in other EMES you have a notably higher impact. We are not in the model actually not going to have as high impact, but the model is sort of tweaked to capture the relatives here between the blue and the red, that you have a bigger impact in AES than in EMES. Now, so with that, let me talk about the trade-offs, so potential trade-offs then for associated with exchange rate shocks. And we are sort of used to look at exchange rate shocks in macroeconomic models. Of course, this UIP risk premium shock, when I mean exchange shock, I mean a UIP risk premium shock. And I think it's a wide empirical support for the view that these shocks are a key driver of exchange rate fluctuations, generally speaking. So we look in a model, we do a 10% exchange rate shock, same size, and the blue line shows what you would get in an advanced economy, and the red dotted shows the effect in our emerging markets calibration of the model. And notice here, the only difference now in the model is this calibration of the Phillips curves, the pricing equation. So what you see is that this 10% depreciation has notably smaller impact on both domestic inflation and CPI inflation. And because it has much smaller effect on domestic inflation, monetary policy doesn't have to tighten as much. And with our calibration that this it's not totally dominant currency pricing, so there is some fluctuation, there is some effect on relative prices. That means that you have mostly trade balance led improvement in the output gap. So you get some positive spillovers on the output gap. Now, in the emerging market economies, where you have a much bigger pass-through on domestic inflation and persistent increase in CPI inflation, there the central bank has to hike the policy rate much more to lean against that inflation surge. And that means that it has to raise inflation to the extent that domestic absorption drives down, drives a decline in output. So trade balance will still, be positive in a sense. It will be, our model will be positive affected, but the tightening of policies is so large that you drive down domestic absorption and output falls. And here you see, a trade-off opens up here for the EME. For the AE here, suppose that the advanced economy, I don't like this increase in the output gap, and I'm going to respond even more forcefully. We have like a standard Taylor rule coefficient on output in the monetary policy rule. And suppose I'm advanced economy and I want I don't welcome this increase in the output gap, and I want to respond more to output. That's no problem. You can respond more to output. You can tighten the policy rate more. Output gap will increase by less, and you will only moderate the increase in inflation. So there is really no trade-off for the central bank in that, for the advanced economy here. But for the EME, if they want to lean, which I actually come to next, if the EME now wants to lean against this increase in domestic inflation and want to pursue a tighter inflation stabilization rule, so you respond more forcefully on inflation because you don't like this surge in inflation, persistent surge in inflation, and you tighten policy rate much more than you do with the standard Taylor rule, then of course you're going to have this much more bigger drop in output. So you're able to contain inflation, well, both domestic, which we think about here, I sort of think a little bit about domestic as core. And you're able to contain CPI inflation as well and bring it back to target within 2 years. But you have a sharp reduction in output as the price of that. So even though we haven't brought in any balance sheet effects yet, you still see this trade-off opening up for potential trade-off opening up in EMES. All right, so that was sort of just sort of small, in a sense, a small shock around the model's linearized steady state. But now let me open up for the model variant, how we introduce these balance sheet channels and how we use the model to study large shocks. So one key nonlinear element is something we call the risk-centric UIP condition. And we call it risk-centric because it includes these sort of 2 additional risk shocks here. Oh, sorry for that when I clicked it. So first, I think the most terms here are standard with the addition that we have this discounting term here. So actually short-term rates means a little bit more for exchange rate than the long-term rates does in these frameworks. That I think is consistent with some work that Jordi Galli has done. But here is the key then. The key is this risk premium, which is not linearized. So the risk premium capital phi depends on debt, total debt in the economy, relative to a debt limit, we call it D bar T. And then you also have FXI term B, that the central bank can do FXI. And if I would draw this risk premium capital phi as function of net foreign liabilities on the x-axis and the annualized risk premium on the y-axis, it will look something like this. In this model, you need some slope around 0, and normally most of our models just have this low slope of this. You make a fairly flat slope of this risk premium, and it's enough to bring about stabilization of net foreign liabilities, or the flip side is of course net foreign assets. So that net foreign liabilities and net foreign assets remain close to 0 in their steady state, and that's true here too. So we have some slope, but then of course we have the possibility here that if net foreign liabilities become sufficiently large, you start to approach this D bar T, the debt limit, and after that, debt limit, investors require a much higher compensation to take on additional debt from this country. So that's a sharp nonlinearity in the model. Now also this D bar T can shift. So if you have the blue line, suppose that's the risk premium function in normal circumstances when there is normal risk tolerance, but then suppose there is a risk off, like during the COVID or during the global financial crisis, then you can shift the blue line shift to the red, and this curve shift up. And then of course, if you're a country which has say 40% of GDP in net foreign liabilities, you're fine under normal risk tolerance. But if that risk tolerance shifts down, you can see your spreads shooting up quite a bit, which a country say which has 0 net foreign liabilities is not exposed for. An additional issue, of course, that when you're here, or suppose you're around 30%, which is actually what we're gonna assume, is that you're hit by this risk-off behavior, so the risk premium function shifts against you. But of course, in addition, so that will drive up your debt service cost. But in addition, normally when you have these episodes, like the global financial crisis, now during the COVID crisis, of course, your export demand, falls like a bomb as well. So that means that you're generating notably smaller trade surpluses. So you're not able to pay off this increased debt service cost with trade surpluses, so that you have a need to borrow, and you're further increasing your debt in such a situation, and that makes you ride on this red line here. You're actually increasing your debt during an episode like this, and that drives up your risk premiums even more. Now we have this B. I just want to say this FXIs, and they, in our model, the way we model them, that they will be effective. It's not microfounded here, so we sort of bring them in. It tries to capture, though, the microfounded model by Roberto Chang, in the sense that FXI will be mostly effective in our framework to affect risk premiums when you're on this slope here. If you do FXIs here and you want to move the exchange rate, you have to do a tremendous amount because the slope is so low there, so you have small effects. So it's not microfounded, but I think the way we introduce FXI sort of captures the spirit of the work by Chang. Then finally, you see that you have the minus tau, and that's a outflow CFM, a capital flow measure, and I refer you to Deborah and you who do derivations of that. So in a sense, that is sort of accordance. It's a microphone. Great thing. All right, so now let me just tell you about the balance sheet channel finally, and it moved again a bit quick. And there you have the consumption Euler equation. Oh my God, I really want to move forward. I don't know. I'm not touching the computer, and it still moves forward anyway. Okay. Again, it's how can this be? It's an autopilot. Is it all? If you're telling me I have to move on, oh my God, I need to. Okay, it really doesn't want to have that slide evidently. So anyway, there is discounting in the Phillips curve, as you can see. Oh my goodness. And then you have this net foreign asset. You have this risk premium, which is capital psi. And that is now a function following Bruno and Shin. I'm just going to tell it. Evidently, it doesn't want to be there. I can't move back again. It is a function of the real exchange rate instead. So it's the same thing. When the country is experiencing risk off, and if you have a weak exchange rate to begin with, which could be a situation you are in if you have a lot of net foreign liabilities, you need a weak exchange rate to run trade surpluses to service the cost of the debt. Then it makes you vulnerable, so private borrowing spreads shoot up when your exchange rate depreciates. So we capture that mechanism with also this nonlinear function. Again, if you don't have a weak exchange rate and you don't have a lot of net foreign liabilities, you will not be, your spreads will not shoot up. Okay, here the slideshow allows me to stay. So here I actually here we have just the standard debt accumulation equation for net foreign liabilities. This debt service cost and the trade balance, inverse of the trade balance, and then you have this effective interest rate depending on the change in the exchange rate, nominal exchange rate, ST, and then this risk premium component. Right, so let me just...
Jesper,
yeah, 15.
You have 9 minutes.
Okay, very good, thank you. Okay, so let me go quickly. So now turn to use of FXIs and CFMs in stress scenarios. So we now move to analyze how economies with weak initial conditions can be more vulnerable. So now I'm going to use the full model with its balance sheet channels and FX mismatch to allow to analyze a COVID-style stress scenario where you have heightened global risk aversion. So these risk premiums will shift to the left, as I showed you, plus falling export demand. So the economies are exposed to two shocks, falling export demand and this shift in risk off. Now, of course, you can model the COVID. You can add a lot of things to COVID, but we think at least for many small open economies, these are two key forces at work. And I'm going to show you two countries, compare economies with initial conditions, low versus high debt. And this is focus on the EME calibration in terms of inflation in wage dynamics. So the red dotted shows you the low exposure economy, so that you start out with zero net foreign liabilities. And the high exposure is an economy which starts out with 30% of GDP net foreign liabilities. And for the same shock, what you see is that you're going to experience, the country is going to experience a much bigger, the vulnerable economy is going to experience a much bigger real exchange rate depreciation because they are going to see, both the private borrowing spread shooting up much more, this capital psi, and the UIP risk premium shooting up much more. And that will lead, relative to the low exposure country, where you mainly have the falling export demand at work, which here would contribute to 2% decline in output. That increase in the private borrowing spread and in the UIP risk premium drives almost a triple of that deterioration, so -6%. And at the same time, you're going to have inflation rising. So because the real exchange rate is depreciating so much. So the central bank, it has a sharp trade-off here for the high exposure economy. It has inflation running high because the exchange rate has depreciated so much and it's expected to remain weak, but you have output very weak. So how could you possibly deal with this situation? So here we show some more variables. So here we now just focus on the vulnerable EME. And I look at two additional instruments here. So in addition to the policy rate, in the red dotted line, the central bank can do an FXI and intervene to weigh against the depreciation of the exchange rate. So it removes some of that depreciation. And the black dash shows the effect of a CFM, in tau, and both are here discretionary policies. So they're just here, shocks with roots 0.85. Now, what you can see is that both policies, they're scaled, so they roughly give the same average appreciation, or weigh against the depreciation for the first 10 quarters. So the idea is that both of these, the fact that the exchange rate doesn't depreciate so much means that you get lower inflationary pressures in the near term. You lower, and that means that the central bank can focus more on doesn't have to tighten policy as much. You get a much smaller increase in private borrowing spreads, which then mutes the adverse impact on output. In this case, it's not perfect here. It's nothing, I don't try to optimize anything here, but you could, of course, reduce the output decline even further by doing more here in a sense. Now, the way FXI and CFMs will differ in our framework is that because FXIs directly work on the UIP risk premium, they will also lower the UIP risk premium, whereas an CFM, which doesn't lower the UIP risk premium, that just moves directly as a wedge in the UIP, that will be associated with actually an increase in the, in a sense, sovereign risk premium, because that country can accumulate more net foreign liabilities, allows the country to accumulate more net foreign liabilities, and you don't have to pay off those net foreign liabilities by improving the trade balance as much. So you can run that higher net foreign liabilities, and that works out. All right.
You have 4 minutes, Jesper.
5 minutes, yeah. So I'm going to be quick. So just giving a few minutes to talk about systematic policy rules. So there, what I looked at now was just sort of discretionary FXIs and CFMs. I think that deploying these tools systematically when risk spreads widen can reduce downside risk to output. And effective policy rules for these two tools respond aggressively when UIP risk premiums and/or private borrowing spreads are elevated above their fundamental values. And in this context, we found out that both CFMs and FXIs may be useful. And in addition, relative to comparing how much you do it, if you do this by rules rather than discretionary policy, we find that, credible commitment to well-communicated policy rule may imply that smaller interventions are needed to achieve stated objectives, say, relative to a discretionary policy. So to show this, we do stochastic simulations of the model with and without CFM and FXI policy rules and compare outcomes. So here I have, in the blue line, we have the model without any intervention. So it's just interest rates that are used for macroeconomic stabilizations. And in the red dotted, I allow the central bank to additionally use these FXI and CFM policy rules. I simulate the model 50,000 periods. And these are sort of histograms where I then drawn a sort of smoothed line through this histogram to show you the main tendency of the outcomes. So what you see is that basically in the model with this FXI and the CFM additional tools for the central bank, you basically have very little mass below -5%. So you almost turn the output distribution symmetric relative to the model without these tools. And that is by minimizing these very large exchange rate depreciations, which happen occasionally due to these risk-off shocks. And that means that you also don't record as high inflation outcomes. And the key, of course, in the model is that you reduce downside risk to output or growth at risk by reducing the growth at risk in domestic output. So that's how we think. Here, we could boost by considering more optimized rules. So we haven't sort of, in a sense, done optimal rules here for neither monetary policy nor these additional tools. So I haven't re-optimized the monetary policy rule given that the FXI and CFM tools are available. So just a very few, I might running out of time now. So dealing with the liquidity trap, we think here that FXI can be useful to boost inflation output in an economy with low inflation and policy rates at its effective lower bound. It may be useful if other unconventional policy tools cannot provide sufficient stimulus, and you have a situation, say, where medium and long-term inflation expectations feed on actual inflation outcomes, feed stronger on that. So by raising actual inflation, that might, help to boost the inflation expectations. And this sometimes is viewed as a beggar thy neighbor policy, but here we just note that since in this economy you have a liquidity trap, you are lowering the real rate, you boost domestic absorption, and that will moderate at least the beggar thy neighbor effects. Okay, I'm just going to take 1 minute to conclude, Ulf, and I'm just going to say here that economies with less well-anchored inflation expectations, significant foreign currency mismatch, we think they can potentially benefit from using FXI and CFM tools. However, we do, of course, want to underscore that medium and longer-term costs need to be accounted for when deciding whether or not to utilize these tools systematically. And for instance, if use of FXI and CFM to slow the development of FX derivative market and the current FX debt, that is something that our analysis clearly don't take into account. And here, future work is needed to quantify these risks and incorporate them into structural models. Thank you very much.
Thank you very much, Jesper.